You hear it everywhere, right? AI is going to change everything. But here's the thing. There's this uncomfortable truth that nobody really wants to say out loud. And it's that the prices we're all paying for so-called AI stocks are just way, way ahead of the actual cash these companies are making. So that's what we're going to dig into today, this massive disconnect.
You know, there's this quote from the source material that just absolutely nails it. The tech is flying, the cash flow is crawling. And it's so true. We're seeing these demos that are just mind-blowing, stuff that feels like it's straight out of a sci-fi movie. But then you pull back the curtain, you look at the financials, and the money just isn't there. It's not keeping up with the hype.
And that really is the big question, isn't it? If you own Nvidia or Microsoft or really any company in this space, what are you actually paying for? Now, the goal here isn't to tell you to sell everything, and it's definitely not to hype AI to the moon. The idea is to give you a simple, powerful framework to help you separate the AI story stocks from the companies that are actually turning this incredible technology into real, repeatable profit. Okay, let's get into it.
All right, Section 1, the AI profit paradox. This is where we just strip away all the exciting headlines and look at the cold, hard numbers. And when you do that, the gap between great tech and weak business becomes, well, crystal clear.
So get this. In one survey of executives at big companies, only about 20% of them said that AI had boosted their revenue by more than 5%. I mean, think about that for a second. For all the breathless headlines we see every day, the immediate impact on the top line for most companies is tiny. In fact, more than a third of them said it made no meaningful difference at all. And it gets even more stark from there. A study connected to MIT found that a staggering 95% of companies that are experimenting with AI are seeing no real financial return. What that means is they're spending a ton of money building these really cool demos and impressive slide decks, but that investment just isn't showing up where it actually counts, on the bottom line.
And that really is the paradox, right? AI looks like pure magic when you see it in a demo, but on an income statement, it often just looks like a giant money pit. The technology is incredibly strong, but the business side of it, it's still proving to be pretty weak, at least for now.
So that brings us to our next point, and honestly, this is where the economics start to get really weird. We can call it the cash-burning treadmill. For a lot of these AI companies, their core business model is broken. In a way, that means the more they grow, the more money they can actually lose.
What's so wild here is how this completely flips the traditional software model on its head. See, with old school software, yeah, you have big costs up front, but every new customer you add is basically pure profit. Your margins, the money you keep from each sale, they get better and better as you scale up. But for so many AI products, it's the exact opposite. The cost to run these models on powerful GPUs is just enormous. So every new user actually drives your cloud computing bill higher, while the money you make per user stays flat. More usage can literally mean worse margins. It's not a profit flywheel, it's a cash-burning treadmill.
So this leads to the obvious question, right? The one that's maybe a little bit scary. When you look at these economics, you have to ask, are we in an AI bubble?
You know that saying, history doesn't repeat, but it often rhymes? Well, think about it. During the railroad boom, we built way too many tracks, way ahead of actual demand. During the telecom boom, we laid down way too much fiber optic cable. And in the dot-com era, we built countless websites just to chase eyeballs. So the question for today is, are we doing the exact same thing right now? Just overbuilding compute, filling up data centers with GPUs before we've even figured out the profitable business models? And the numbers are they're staggering. Some estimates suggest that the big tech companies are on track to spend around $500 billion a year on capital expenditures, mostly for AI infrastructure. But the current profit estimates for 2026, they're closer to $450 billion. That gap is enormous. Now, the technology will almost certainly survive long term, but the real question is, will today's shareholders survive long enough to see the payoff? Okay, so that's the problem. And yeah, it might sound a little grim, but now let's shift gears. Let's talk about the solution. This is Section 3, where we're going to build a simple framework you can use to separate the real value from the mountain of hype out there. First things first, we've got to define a critical term, the AI story stock. You've seen this company. Their revenue is growing, the CEO says AI about a dozen times on every earnings call, but when you look at the actual numbers, their free cash flow, the real cash left over after running the business, is negative. And their profit margins, they aren't getting any better. The entire investment thesis is basically just, don't worry about it, it's AI.
So what's the alternative? What should you be looking for instead? It really comes down to three simple things. First,
Look for companies where AI is just an accelerator, not the whole story. They've already got a strong core business, and AI just makes it even better. Second, you have to be able to see the impact of AI in the numbers. Look for improving profit margins, not just exciting words in a press release. And third, the spending has to actually lead to returns. When they spend a ton on new data centers, you should see a clear jump in revenue and cash flow pretty soon after.
So drawing from the source material, here are 3 personal rules for managing this risk. First, position size. If a stock feels like a story, keep your investments small, like 1 to 3% of your portfolio max. It's a speculation, not a core holding. Second, valuation discipline. This just means don't overpay. Paying 20 or 30 times a company's annual sales for a business that has no profits, that's a huge red flag. And third, demand operating leverage. All this means is that as the company sells more stuff, its profit should grow even faster. If the margins don't get better with scale, it's a no deal.
Okay, to bring this all home, let's finish up with a simple, really actionable checklist. This is your 5-point test. The next time you hear about some hot new AI stock, just run it through these 5 questions.
All right, here's the test. Red flag number 1, is their free cash flow negative while their AI spending is ramping up? 2, are their gross margins actually getting worse as they grow? 3, the buzzwords. Does management say the word AI more than they say the words free cash flow? 4, that bubble multiple. Is the stock trading at some sky-high valuation, like 20 to 30 times sales with no clear path to actually making a profit? And finally, 5, is there a moat? Or could a customer easily switch to a competitor because there's nothing powerful locking them in? So here's the rule of thumb. If a company checks 3 or more of these red flag boxes, you should treat it as a high-risk speculation. It's not a core, long-term investment. It's a trade, and you got to handle it with extreme care.
Because when all is said and done over the next few years, the market won't ultimately reward the companies with the loudest stories or the flashiest demos. It's going to quietly and consistently reward the companies that actually get paid every single time their AI model runs. And that's what you need to look for.